All right, we are live. So, welcome everybody to the weekly multifamily roundtable, and we are doing a three-part series. You're coming into us on episode number 2 of 3 of the Complete Beginner's Guide to Passive Investing in Apartment Syndications. And today we are going to be diving deep into the value-add business model. Are you guys pumped?
I'm giddy. I'm downright giddy, guys. I can't
This
contain
is
it.
always an exciting topic.
I don't know if we want giddy, but we'll take it.
Well, you're getting giddy because when we talk about multifamily investing, it's the value add component that gets me the most jazzed up. I mean, real estate investing is fantastic. You can do single family, fix and flips. You can do note investing. Like there's a ton of ways to make money, but this is, I think, definitively the best way.
Yeah, same for me. When I really got my head wrapped around this component, that's when I was like, oh my God, this is awesome. Just because I think it's really the piece that really puts control into the investor's hands, which is what, differentiates this from other investments, in my opinion. So
this is the part when you show it to somebody. I mean, you can't help but get excited of what you can do with the value add component of an investment. It's
it's a no-brainer.
Yeah,
which we will prove multiple times over in this session.
We will prove it. You will walk away having been convinced that this is the best way. But it's also one of the interesting things when you're talking to somebody explaining it for the first time, it almost seems too good to be true. It's like, wait, this sounds really crazy. The amount of value that you're able to add in such a short period of time, or even in a long period of time, is just crazy. But what I love about it.
Go ahead.
What I was going to say is what I really love about it is I'm a simple guy, and it's really simple to understand. It's simple to explain. And so if at any point you guys are listening to this at home and you're confused by something, we would encourage you to reach out. We can explain it better if we somehow missed the mark. But this is going to be, if you've never heard of value add, or you maybe have heard of it, but you've never dove into what exactly it means, I think this is going to be a really illuminating episode.
So what is it?
Well, that we don't want to talk about that. It's like,
okay. We don't want to give away the secret sauce.
Yep. So before we can talk about what value add is, I think it's helpful to take a step back and explain the ways that commercial real estate is valued versus other ways, because that really serves as the stepping stone to explaining how the value add model works. So who wants to take a swing at explaining the difference between how a commercial property is valued versus like a single family?
Oh, well, nobody's going to talk all at once. To boil it all down, single family is the value is based on some of the amenities, but a lot of it is weighted on the comparables in the neighborhood. And there is a theoretical limitation as to how much appreciation you can add to single family real estate, whereas commercial real estate is based on the amount of revenue that the real estate produces divided by what is called a capitalization rate. And by modifying the revenue that it produces or the expenses that it incurs, we can directly affect the value of the real estate. How's that?
Yeah, that's good.
Yeah, I think one thing I would say is with like single family homes and even like duplexes and triplexes, I think value is kind of in the eye of the beholder, right? You could drop 10 grand redoing a kitchen in your house, and it's all up to the next buyer whether or not they put a stamp of 10 grand of value on what you did. Maybe it's so unique to your taste that they're not willing to pay 10 grand more for the house because you spent 10 grand on it. But
that's a very good point because, you put a pool in the backyard, you spend 50 grand putting a pool in the backyard, and it doesn't
I'll pay
increase
less
your
if I see
property.
a pool. I don't want to take care of that.
Don't want to deal with that.
One of those blow up ones from Walmart. Is that what you're thinking?
I'll take that one. Yeah.
But I mean, it does not increase your property value by $50,000.
Yeah. But in a commercial property, like an apartment building, it's very quantifiable and it's black and white. And, it just comes down to the fact that commercial properties valued based, it's valued like it's a business, right? If you're buying a McDonald's, it doesn't matter, what other McDonald's have been selling for lately. All that matters is how many burgers are sold, how much cash flow is produced, because that's what you're buying. You're buying the cash flow. You're buying the money that it produces. So if you have an apartment building and you improve it to the point that it produces more cash flow, it is worth more money, and you can quantify exactly how much more value you created with some of the stuff you guys just mentioned, cap rate, stuff like that. So we're going to do a deep dive on that today. But like you said, Anthony, it's simple. It's very simple math, just arithmetic. Mm-hmm. Anybody can do it.
Yep. And we're gonna break down that formula for you guys here in a little bit and show you some numbers, some examples to walk through that. But I want to really drive home a couple of things with the single family distinction between that and a multifamily. And for me, I started, my very first property was a triplex. And I've told this story before, but I bought that triplex, and then within 9 months, without any real work on my end, it appreciated $125,000 when I went to refinance it. And that's merely because I happened to buy the house in November, which is when the market in Minnesota is typically at its lowest. And then I refinanced in September, which is 3 months after June, which in Minnesota is the top of our market. So that's when people are going to be paying the most. And then when winter comes, everybody dries up. Right. So by just playing the market and when I was doing the valuations, I was able to add all this value, like this mythical value, right? Through no fault of my own or credit, really. I did nothing. I didn't run the property more efficiently. Sure, I went in there and I put in better tenants and overall increased the revenue that it was generating, but none of that mattered. It only mattered what the houses within a certain proximity of that property were selling for during that period of time that they pulled the comparables. So when Dan mentioned that we love the control aspect of multifamily, this is one of those things where I had no control over one of the most important parts of the business, which was, how is this thing valued? I couldn't make it more valuable by running it better. I could maybe go and put in new amenities, and maybe that would, entice the next seller to pay a little bit more. But then you're starting to talk about personal tastes, and you can't really account for that necessarily. Like you guys are pointing out, I'm not going to pay more for a pool. If it's there, I'll be like, cool, but you're not getting more money for it. Whereas in the multifamily space, because the value of the building is derived by the revenue minus the expenses divided by the capitalization rate. And we're going to break all that down. What that means then is there's 3 levers that control the value of a building: the revenue, how much money it's bringing in; expenses, how much is going out; and then the cap rate, which is something that we can't control, but we'll talk about that and how to work with it. And within the expenses and within the revenue, it rewards skilled operators. So if you're really good at going in there and making the upgrades that can increase rent, or you're good at going in there and running really efficient operations and you drive down the expenses, well, you just added a ton of value to that property. And that's just the coolest thing to me.
Mm-hmm. Yeah, I love it. It's an addictive concept once you discover it. Now you have, are we ready to throw up our visual guide for people?
Let's do it. Let's throw this thing up here real quick. I'm going to share the screen. We got an infographic here that we created. And so this is a part of the Passive Investing in Multifamily Made Simple book. And this is a before and after example of how the value add model works. And there's a couple of red herrings in here we're going to point out. So if you're new to real estate investing, these are things that you should be on the lookout for, because unscrupulous operators can slide this past you and you not realize it. So as we point out the total value down here of $3,428,571 added to this building, take that with a grain of salt. We're going to be adding a ton of value, but in reality, this is probably a little bit less than what's presented. So
do we have a amount of time that this property was held for?
No, not really. Here, this is really just, this could be
5 years, we could call it.
Well, 5 years could be reasonable. Yeah, I would say most value add model properties are held between 3 and 7 years. So this could be a 5-year hold. Usually a lot of these renovations and upgrades and increases to the revenue and decreases to the expenses are going to take place within the first, I would say, 24 months, the bulk majority of it. And then you'll start to see a slower increase of the revenue as it kind of keeps pace with the market rent increases.
Gotcha. Yeah, no, I think this is a really great little one sheet visual representation of value add from a high level. And I think, some people might be a little bit intimidated seeing the number of units and, all those commas in there. So sometimes when I'm explaining this concept, I like to break it down to just one unit and use that as an example, because I think it's a little bit easier for people who aren't used to dealing with large multifamily properties and hundreds of units to kind of wrap their head around it. It makes the numbers a little bit more real. So, a really simple example of a value add opportunity is increasing the rent. And how do you increase the rent in a unit? Well, what we do is we look for buildings that have been mismanaged and they haven't been updated, and the market rent in the area around the property that we're looking at is higher than what the property we're looking at is currently at, because the amenities aren't there, the appliances are old and whatnot. And so we look for opportunities to find those buildings that are below that market rent. So let's just say that there's a building that's $100 below market rent. What we can do is spend $5,000 upgrading a unit to get it up to market rent, and that might get us an extra $100 per month. And you might say, okay, why would you spend $5,000 to make $100 per month? That doesn't sound like the best deal in town. It's an amazing opportunity because if you calculate how much equity you create in your property off of that new $100 income, it's pretty impressive. So to the point that Anthony made before about revenue minus expenses divided by cap rate, in this scenario, if we increased our rent by $100 a month on one unit and everything else stayed the same.
Dan, actually, we'll hold up real quick. I'm going to let you real quick. I'm sorry to interrupt. I'm going to give you the access here. Do you want to pull up a spreadsheet and just walk us through the numbers that you're about to talk us through? Because the calculations are really simple, and you can walk us through exactly how you would explain it to a new person.
Yes. Instead of me just spouting off numbers, that sounds like a good idea. Share. Let me know if you guys see it.
Yep.
Okay, cool. So let's say we got a cap rate.
Did you already have this up and running?
Maybe, or just type really fast.
He just pulled this out.
I just had it in my pocket. I just walk around with this.
I love it.
So cap rate is 7%. Like, just, that's just for fun. We'll just make it up and say that's what it is. In our area, it actually is for C-class buildings, right around that 7.3, somewhere in there. So let's say, like I said before in my example, we're able to increase the rent by $100 on one unit, and we just have to spend about $5,000 fixing up a unit. So that might be new appliances at $400 or $500 a pop, some new flooring, new paint, new light fixtures. What else? Bathroom, new vanity, all that good stuff. Spend about $5,000 doing it. We get an extra $100 a month. That doesn't sound like the most exciting thing in the world, but like Anthony mentioned before, the value of a property is revenue minus expenses, which is your net operating income divided by the cap rate. So in this case, just to make it super simple, our revenue increased by $100 a month. Our expenses are just going to stay the same, just so we can make this super simple. That means that 100 times 12 months is $1,200. You effectively increased your NOI by $1,200. Now, when I'm doing this, I only take about 60% of that new income and divide it by the cap rate. And that's just my conservative approach to this, because typically what's going to happen is when an appraiser, this is kind of getting into the weeds, but usually when the appraisers are doing the appraisal, they'll kind of let the market expenses kind of influence their appraisal. So even if our expenses don't go up, I still kind of increase them a little bit if I'm trying to forecast what I think an appraiser is going to look at. Anyways, don't want to go too deep into the weeds on it. So effectively, $1,200, about 60% of that divided by our cap rate is $10,000. And that's conservative. If we got rid of my little 60% deal here, it's actually $17,000. But like I said, I'm kind of conservative. So if you spend, so basically what I'm saying is you could spend $5,000 and create 10 grand. So you can
Mhm.
double your money
Just like
almost
that.
like that. And that's value add in a nutshell. Now multiply that by 100 units, right? That's going to look pretty good. Oops, that's 10. One more zero. It's about $1 million. And now the number starts to look a little bit more like Anthony's example there with $4 million of value created. But I think if we just do one unit, I think it's a little bit easier for people to kind of wrap their heads around it. Because I think people see commas, millions of dollars, hundreds of units, and it's kind of almost like out of reach. It's a little bit too far out there. But if we just do one unit, I think it's a little simpler. So yeah, Anthony's example is basically just the big boy version of this. This is just one unit, but this is it in a nutshell. I mean, the best ROI you can get.
Absolutely.
Really.
Yeah, it's when it comes to how much bang you can get for that CapEx buck. You're putting $5,000, let's say, and that could range anywhere between, maybe 2,000 up to 10,000. If it's a heavy value add, you need to go in there and gut the whole building, or maybe the units are in really good shape. And the only issue is the fact that the previous owners weren't keeping up with the market rents. And actually you have a pretty good building. All you need to go in is just bring up the rents slowly over time. And so there's a lot of ways to increase that revenue. We've talked about this in previous episodes of this roundtable. Some of our favorite ways are making the units themselves more desirable and improving them to market standard. But you could also do other things, right? Like you could start charging for parking. You could put in some garages. You could put some storage space in there. Most apartments at this point have laundry on site, but depending on how you're charging for that, that's another revenue source. And in that example, what's so powerful is that's $100, and that doesn't seem like very much, but the downstream effects of it are massive. And so think about if you can bring in another $100 of storage or parking or laundry, that's another $1 million spread over 100 units.
Yeah, no, that's like I said before, this was the part where things got really exciting for me, because it just seems so simple, and you're almost like, it's like too good to be true. How can I invest $5,000 into something and get 10 grand out pretty much immediately? So I guess the next question is, okay, so you spend this money and you increase the value of your property. That's paper money, right? That's not really real tangible funds, so you don't really get your money back per se, right? Or
nope, it's stuck in there forever. You can't touch it. Yeah. It's like
till you sell, of course.
Well, Rodney, play along, man.
Oh, did I?
Well, actually, so there's two circumstances there, right? You could sell, or you could refinance. You could do a cash out refinance and pull a portion of that equity out. And I think that in particular is one of the most interesting aspects of value add multifamily is doing that cash out refinance, because correct me if I'm wrong, it's a non-taxable event. You get that money back, and then you can immediately start investing that again into something else. And if you're a passive investor in the deal, or, not even if you're a passive investor, if you had any money in the deal, you've had a good chunk of that return to you. So it reduces your basis for how much how much capital you still have in the deal, but your equity position hasn't changed. So you're still getting your cash flow distributions. And
yeah, basically what happens is you take a lot of risk off the table.
Yep.
Right. So let's say you put $100,000 into a deal, 12 months into it, you get about 50 or 60 grand back. Well, that's 50 or 60 grand that you don't have the ability to lose now, right? It's like you're almost playing with house money at the casino. You put down $100 on blackjack, you win 50, right? You take half of your initial money out, half of the money that you're using now is house money. After a couple of years in some of these deals, you can get effectively all your capital out, and there's literally no risk anymore. Like all your initial investment is out, and now it's just house money, and you've got an equity position essentially for nothing. It's paying you cash flow. And yeah, no, that's why this business model is amazing.
And in a previous episode, when we talked about how financial freedom is a whole lot easier to get than maybe most people think, especially within multifamily investing. This is why, like that cash out refinance aspect, or even selling and getting that money back. But with the refinance, you take that money, you roll it into another deal, and it's doing the same exact thing for you. It becomes a really powerful snowball.
Yeah, and with interest rates where they're at now, I mean, it's a no-brainer to hold assets, refi, lock in these historically low rates. I mean,
Mm-hmm.
Why not pay 3.5% to use the bank's money, right? Why,
Mm-hmm.
there's really no reason to sell. I mean, obviously
This is
there's some
why you
reasons to sell,
hear,
but
this is the reason why you hear going into it, yeah, it's, you don't make your money in the sale of the asset, you make your money going into the asset. Because if you buy it right, then you can refi it, pull all your funds out of it that you put in it, but yet maintain your equity position and keep producing in cash flow from where you were in the, with all your money back out, that
yeah,
now you can go do that again.
it just makes sense when interest rates are so low. I mean,
Mm-hmm.
money is free to borrow from the bank. So it's like, why
Now,
not leverage as much of the bank's money as you can? I mean, within reason. Don't borrow 120% on an asset and go
now
crazy.
the only pushback I'll have here, because I agree fundamentally with the idea that you make your money when you buy. Like, buying right is a huge component of it, but to execute the value add model, it depends on your ability to actually go in there and execute well, right? And so let's not overlook that and like kind of gloss over, because that's kind of sometimes what happens with the value add model. Is it sounds so good and so simple, and it is, but simple doesn't necessarily mean easy. And so you actually have to go in there, you have to do the renovations, you have to run it on budget, you have to do the unit turns, get the new tenants in there, you actually have to hit the projections that you've made for yourself, and that's not as easy as some
Well,
people
this
might
goes
think it
back
is.
to where we were talking about, choosing your operator,
Yep.
right? We talked about how do you choose an operator, and why you would choose an operator, because of the experience that they have and exhibiting the ability to run a deal like you're talking about. Because you are correct. I mean, you can place your money in there and it doesn't magically multiply, and you take money out and then blissfully go along continuing to do cash flow. There is a ton of work, and you need to know, or your operator that you're investing with, if you're a passive investor, needs to understand how to run this business. Because every time you buy an apartment complex like this, you are buying a business, and you're in effect, as an operator, running multiple businesses, and
Yeah.
doing that efficiently is what's going to produce income and returns for your investors.
Yeah, and that value add thing could be a tricky one for people as well, because it's not uncommon for people who are newer to this uh, to spend money poorly when they're trying to add value. I
Yes.
just threw up an example that said, hey, if you spend $5,000, you're going to increase the rent $100. That doesn't mean that just because you spent $5,000 doing stuff, you're going to increase the rent, right? It's over upgrading is very common. So let's say you buy a C-class asset. Are you going to put a $2,000 refrigerator in?
No.
Is someone going to pay more because there's a $2,000 refrigerator in a C-class asset in a C neighborhood? They
Or
might
even
really
granite
enjoy it.
countertops. That's
Granite
another thing. Granite
countertops,
countertops. Everybody thinks you got to go with granite countertops, and it may not
you
be,
will not get your
the
money
area may
back.
not warrant it.
Yep.
No, there's only
Brand
so
new
much someone's going
cabinets.
to pay. Yeah.
Yeah. So in our space, like, brand new cabinets can also be quite prohibitive in terms of cost, but just going there, resanding and refinishing and repainting can go an equally long way. So it's just a matter of understanding what are people going to be willing to pay more for, and then don't go above and beyond that, because
Yeah.
you're just wasting money and time.
Yeah. It's basically do the minimum to get the increases that you're looking for. Obviously, you want your units to be safe and secure, and to provide a good living environment. But as far as trying to increase the value by adding bells and whistles and making things prettier, do the minimum to get the amount of rent that you're trying to achieve. And anything more, just like you said, is wasted money. And every dollar you spend that you don't need to spend is going to chip away at that ROI and your return. So
There is an interesting theory, and I know a couple of operators in the space who they actually go in and they do much heavier renovations than the property itself really would require. And so they might go into like a C-class property. Chances are actually they'll go into a low B class and try to turn it almost into a low A. And
Mm.
their thesis being, hey, if we make all of these upgrades right now and do really heavy value add, well, that's going to be all new appliances and flooring and everything. And so then our CapEx expenditures are going to be way lower. And then also during a recession, there might be, a theoretical flight to quality, and then that positions them well to be competitive. But they're going in with this very particular strategy, which is we're trying to renovate this thing up into a whole different class, which when you're going into a C class building, you're not trying to go in there and turn it into necessarily a high B class. You're trying to turn it into a high C class and trying to be competitive with the rest of the market around you.
Yeah, I think
And
with our deals, we're basically just trying to get them up to baseline, up to
Yeah.
par. We
And
find
sometimes
stuff
that-
that's just been mistreated and just get it up to even.
right. Sometimes that works, if you have an area that's going through gentrification and you do have an older building that has deferred maintenance and the entire area is being built up, then it may warrant doing that, where you're bringing it up, you're bringing a C minus up to, a B plus, because the area will support it. But it all goes back to what everybody says about location, or, real estate is location, 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 right? I mean, you can't expect to go into a heavy C area and take that building to a B plus and have it stay occupied.
Mm-hmm.
And so, back to what you said, Dan, I think taking it to a level that the area will support, that the market will support, is where you want to be, because you do want to have a nice product to be able to show to your prospective residents, but you don't want to be so far overkill that there's no way that you can recoup the capital that you put into the thing.
Mm-hmm.
I just realized we're talking a lot about the different classes of real estate and properties in particular. And I don't know if in the last episode we actually addressed that. So what's the difference between A, B, C? And that's actually a really important distinction because the value add model really works best within a particular niche. So maybe somebody wants to drop some knowledge on that.
Sure. An A class, as you might have guessed, is going to be brand new builds, hot area, all the amenities, the nicest, the newest, the best stuff you can find. And the most expensive as well. That's where you're going to want to see granite countertops and stuff like that. B class is basically probably would have been A class like 10, 15 years ago, or it is brand new, but it's not in like the prime areas. So maybe a nice new place that's just a little bit outside the hottest neighborhoods. Still some amenities, but probably not quite as bougie looking as an A class.
Bougie looking.
Bougie. And C class is going to be, more down towards kind of middle class, average, affordable
workforce
housing, workforce. You're not going to really see amenities per se. You're not going to see, you might see a pool here and there, but that's about it. You're not going to see like a really cool workout room. It's not going to be a yoga studio, or there might be a dog park, but the amenities are going to be limited and usually a decent amount older.
So the question would be, can you have a brand new C class property?
No. By definition, no. And that's part of the
you could have brand new workforce housing, but I just don't think I would call it C.
Yeah. So would brand new workforce housing that has middle of the road appliances and not all the amenities,
it's all subjective.
You might call that affordable housing, right?
Yeah.
Like there's affordable housing projects where they're newer, and usually there is a market split where some of those units are going to be at market rate and some are reserved for affordable housing families and whatnot. But even in that case, that building still wouldn't qualify in my mind as a C class building, even though the tenants are comparable to what you would see in a C class building.
Yeah, in the same way, I think if it's a new build, I subconsciously are going to look at it. I'm going to look at it as an A class, even if it's affordable housing.
Mhm.
So
You did say B class new, which I would agree with that. I think
Yeah.
that you can probably get a B class new.
I would agree with that.
Yeah.
But the C class, what's interesting about that and why it lends itself so well for the value add is because there is a limited amount of stock. You can't just go and build it because the cost of building it is prohibitive. And so there's a set supply and demand issue here, which makes it then a very desirable asset to have if you're of the sort that can go and operate it efficiently and well. But
So
that
what
also
you're
makes it very
saying is
competitive.
the buildings transition through these classes. Is that what you're saying?
Yep. Over time, they kind of slide down. So today's A class will be the next decade's B class. And this right now, B class will be in 10 years, the C class. And what that means then is like the C class, if you're not going in there and doing these renovations and upkeep to keep them up to par, they're going to slide into D class eventually. And that's what happens a lot of times, I think, with mom and pop owners that don't maintain the properties well.
and I think usually D class, it also kind of implies a certain level of crime too.
Mm-hmm.
So, even if a C class property isn't maintained and it starts to slip into D class, um, in that state of repair, I still don't know if I'd call it a D class property, because in my mind, D class is always kind of in the hood, right? You've got some crime, you've got some sketchy people, you've got some shenanigans going on. So,
So can I
it's
buy
tough though, because
can I buy a C plus apartment building and turn it into a B class apartment building?
Yeah, I think
easily,
so.
I think that's
Yeah.
a pretty popular strategy, I think.
I think
So
you'd
that
have a
kinda
hard
would
time
just-
taking like a C minus and turning it into a B, but it could be done for enough money. It might not be worth it, but then again, it really depends on the neighborhood, right? Like
Yeah.
maybe this C class building finds itself in the hottest, sexiest neighborhood, and it's just bougie out the get up, right? It might be
Tons
worth
of
going
deferred
in.
maintenance.
Yeah, it might be worth going in there and spending 20,000-30,000 per unit to bring it up to like a high B potential.
Yeah, well, I mean, if you look at some of these old warehouse conversions
Yeah.
that happened, I mean, you're taking something that was essentially condemned
A
and
shell,
turning it into
yeah.
the nicest stuff in the area, the
Mhm.
the most expensive penthouses. So it's,
Yeah,
I mean, all
and
this stuff is really subjective at the end of the day. There's no like black and white definition for A, B, C, D. So
Yeah.
everyone's going to kind of have their own little take on it. But
Yeah. Well, that
it's
goes back to what
ours.
I was saying earlier. You were when say that something is always a particular class, but if it's going through like the gentrification of a lot of areas that are like old warehouse districts, for example, that's kind of a trend where they'll take an old warehouse and make it into lofts, and they're commanding really
Top
nice
dollar.
rents.
Yeah.
Oh yeah, and they do have the workout rooms and the yoga studios and the granite countertops and the real high ceilings with lots of windows, and that was a shell
Mm-hmm.
the year before.
Mhm.
So would it
Yeah,
be
so-
fair to say that these are fluid rules or fluid categories to that we
Oh,
live
yeah.
by somewhat?
Everyone's going to have their
definitely.
own take on it, I think.
Yeah, and I
Yeah.
think for the people watching at home, if you're new and you're listening to this conversation, trying to understand the value add, the reason this is important, this classification of properties, is because the type of properties we look at, I think in this group, are C and low B class properties that you can then upgrade and get these. You can command these rent premiums. Whereas there are other players in the field that look at, B and turn it into an A class, or they just go and buy A class buildings, which is, core commercial, and then they're just receiving a small little cash flow yield. And so what they're investing for is very different. So depending on what type of investor you are, what type of returns you're looking for, you might be looking more at the value add side. You might be looking more at like a really stable core piece of property, like A class.
Yeah, that's really, I mean, there's really no value to add on an A class. It's already at the top. You can't add more value because it's already, the best. So you get what you get, which is, why I like the our niche, especially, you know, when we go through shaky economic times. When you have that value add component, it's essentially it's like an extra revenue stream. You know, it's another way for you to make money off the deal that's there for you, where you're not just relying on time to pass and hopefully some organic appreciation to take place.
Yeah. So I want to bring this back to the actual equation to derive a building's value, which again is NOI divided by cap rate equals the building's value. And NOI is the revenue minus the expenses. Okay. And those are two levers that we control. The third lever is the capitalization rate, which we talked through really, really quickly. We mentioned it, but we didn't actually explain what it is. And I think this might actually be a good juncture to kind of talk through cap rates.
Yeah. One thing that I wanted to mention before we move to cap rates is you've mentioned several times that NOI is income minus expenses. And the one thing that we didn't point out that we probably should is that that does not include debt service, debt service is not included in that equation. That's what they call an expense below the line.
Yeah, that's a good clarification. The idea there is that the debt doesn't affect the value of the building, because the debt you take out, Dan, might be different than the debt I take out on the building. And so we need to have a way.
My debt?
Your debt is not as good as my debt. That's all I'm saying. And that's just, that's proven.
Yeah,
but
typical.
And so when we're doing these building valuations, we're using these formulas, or like thinking about these as businesses, we want to remove any of the variables that they don't matter, because they're not going to be the same for everybody. So I might have different debt on this building. I might put more down than Dan did. He might have a higher interest rate or whatever. And so that affects everything.
Straight cash.
Might just pay straight cash. Exactly. So yeah, it's a good clarification, Rodney. Like, the debt doesn't play any factor in it. We're just looking at purely at the building and saying, on its own, how much does it generate in revenue? How much does it cost to run it? That number that's remaining is your net operating income. And it's a critical number. The other number then is the capitalization rate, which is a deceptively tricky concept for a lot of people to wrap their head around.
Yeah, it's counterintuitive. But it's like you said, the cap rate is the capitalization rate. And it's in its simplest form, it's essentially what rate of return the market is currently demanding for a particular type of asset in a particular location. So it's going to be unique for A-class properties in Minneapolis and, C-class property in Nashville. They're all going to have their own cap rates, right? But, per your area and per your asset type that you're looking at, there's kind of a market determined rate of return that investors are going to demand to get from an asset. So what does that mean? That means that whatever price someone pays, the NOI has to be X percent of that. So we mentioned before that our cap rate in our example was 7%. That basically means that investors or the market are demanding a 7% return on their money if they buy these types of assets. So that means that the purchase price needs to be something such that the NOI ends up being 7% of the purchase price, because your NOI is essentially your rate of return if you bought it all cash. Right?
This might be a good opportunity to bust out that spreadsheet again, and maybe
let's do it.
Yeah, let's walk through this, because once you see the visuals of it, I think it makes a lot of sense. But this is the reason I wanted to segue to this part of the conversation, is because as we talk about the different classes of buildings, A class, B class, C class, those are all going to demand a different capitalization rate because of the amount of risk or amount of opportunity or returns inherent in that. So typically an A class building is going to have a lower cap rate versus a C class, which is going to have a higher cap rate. And we'll run through some examples here that help make some sense of that. The way I think about cap rate, and maybe this will help simplify it for people, is because we treat these buildings like a small business. When you're evaluating a business, depending on if you're in light manufacturing or you're in retail or whatever, there's always a multiple that you can multiply your EBITDA, which is your earnings before interest, tax, depreciation, and then and amortization, to then say, this is what this business is worth. And that might be a 2x multiplier, it might be 3x. And really the cap rate is that. It is a multiplier, but it confuses us a little bit because it's expressed in percentage terms. And it's not just a simple 5x or 6x, it's 5%. And so it's not super intuitive how that then correlates to the end value of the building.
Mm-hmm. Yeah, and it's counterintuitive also because you'd think that if something called a cap rate increase, that would be a good thing, right? Just naturally you think, okay, cap rate's going up, that's got to be good, right? That actually means that the market is demanding a higher rate of return. So if a building produces $50,000 of income and the cap rate increases, that means that the market is going to want to pay less for that asset because it's only going to spit out 50 grand. So if all of a sudden the market is demanding a 10% return, they're only going to pay a price such that $50,000 is 10% of whatever the price is, right? So it's cap rates going up is great for a buyer, but it is not great for a seller. So it's counterintuitive. Most people are looking at this from the seller's point of view, or the owners, right? So when they're making their projections going into the future, a cap rate going up at first glance might seem like a good thing, but as an owner looking to sell, it's actually not what you want to see. So I threw up this little example just to kind of go through the arithmetic of this, just to make sure people really understand it. The cap rate can be found a few different ways, just like, with anything in algebra, you can solve for X, you can solve for Y. So we can figure out the cap rate if we know the value and the NOI, or maybe we know the cap rate and we know the NOI, but we don't know the value, right? We can almost solve for one of these variables. As long as we've got at least two of them, we can back into the other one. So we can take this from the perspective of not knowing the cap rate. We can look at a building and know that, hey, it's selling for $1 million, and per the broker's documents that they sent us, it's got an NOI of $50,000. That means that the cap rate on this building, as they're marketing it, is 5%, right? And if we knew that we had an NOI of $50,000 and we knew I had a value of $1 million, well, I guess that's the example I already did. But let's say you didn't have the value; all you had was the NOI, and the market cap rate is 5%. All you have to do is divide $50,000 by 5%, and you'll get $1 million as the answer. So,
yep. Now, if a broker is coming to you with this, and this is a C-class building in St. Paul, what's the first thing you look at here and say and ask?
It depends on the broker that's showing it to me.
That's true.
Someone a couple months ago just told me that he only lists things at 4.5 cap.
Really?
No matter what it is, C-class. I'm not going to say his name.
Oh, interesting.
But I laughed. I was like, okay. That's cool. You're confident.
Yeah, this is where market specific knowledge comes into play. Like understanding what does your market currently command for A class, B class, C class.
Yeah, and it's no secret. You can Google it. You can just Google cap rates in, insert your city. You can look this stuff up. I think it's the IRR Viewpoint report has a pretty comprehensive section, or maybe it's in various parts. But anyways, that you should be able to get good cap rate info out of that, and also the Marcus and Millichap. I think they have a cap rate specific report they put out.
CBRE does. CBRE puts out a cap rate.
Maybe it is CBRE, yeah.
Yeah, for nationwide.
So, I'll get this off here because I think people get the concept. It's simple, but it's not easy to really wrap your brain around. You've got to kind of force yourself to think through it a few times, and then it'll start to kind of make sense. Almost like riding a bike. It's weird at first, and then you get it.
Yep.
So
And so one of the things, last thing I want to point out with the cap rate, and then we can kind of walk away from that part of the conversation, is when you mentioned as the seller, we want the cap rate to ideally be going down. Like we don't want it to go up when we sell. That would be a bummer. But when we're underwriting, it's actually very important to assume that the cap rate is going to increase versus when you bought it. And so if you're buying right now at a 7 cap, you don't want to project that in 5 years you're going to be able to sell it at a 7 cap. You're being too optimistic that the market isn't going to change in some way. And so to account for that, what conservative underwriters do is I think, Rodney, you account for, what is it, like 20 bips? Per year?
15 mostly.
15?
We stress it at 20, but yeah, the cap escalation rate is what
Mhm.
everybody calls it. And yeah, most of the C class, 15 to 20 or 0.15 to 0.2, excluding the first year. And then that's mostly where I am. I don't do a lot of, don't do any A class stuff or B class. Mostly it's C moving into B. So
Mhm.
yeah, 0.15 seems to be a good rate.
And just to clarify for people, Anthony mentioned bips there. That's that means basis points, which is 1/10 of a percent. So when you say 10, 15, 20 basis points, that means 0.10, 0.15, or 0.2%. So less than a percent, basically.
Yep. So 100 bips is 1%.
There
Yep.
it is.
And as we're doing these underwriting, then, Rodney, he underwrites that every year their cap rate is going to get worse. It's going to go up by 15 basis points. So if it starts at a 7% cap rate, then in year 2, if they were to sell it, they're going to assume that they're going to sell it at a 7.15. And in year 3, if they were to sell it, it would be 7.30. And that's just a way to be conservative, to say, we don't know what the market's going to do. But if the deal works with that kind of sliding cap rate going in the worst direction, then you probably have a good opportunity on your hands.
Mm-hmm. Yeah, basically price and cap rate are inversely correlated. If all other things are kept equal, your price is going to come down as your cap rate increases. So like we said before, great for buyers, not so great if you're on the sell side. So, typically not everything stays exactly the same. So typically, even if the cap rate is going up, and which basically means the market's getting a little bit softer, buyers are demanding lower prices. Typically you're going to be increasing your rents, you're going to be managing your expenses. So even as you guys have these not so favorable cap rate assumptions built in, your operations are such that you should still be seeing your property appreciate in value, especially if you're doing value add. So even if the market's getting worse and you're buying a mismanaged building, you're fixing it up, you're forcing appreciation, and you're managing it well throughout that entire cycle, that's how you're able to make money in a declining market. And then if it doesn't decline and it just keeps doing what it's been doing for the past 10 years, great. Then you're good. But
yeah, you're doing a happy dance at that point.
yes, you are. You've been doing happy
You can
dances
also
for the
look
last
at
10
that
years.
cap rate as a risk factor, because typically the higher the cap rate, the riskier the investment is.
Yep. Yeah, that's kind of the idea behind it.
Or there's just less demand too.
I
It might not be riskier, but it just might not be as hot, which I guess maybe is
because you're going to see the
risky.
higher cap rates in the less desirable areas, the C minus, the area,
or even in like a declining city, right? It could be in a nice area of a dying city, and so Detroit's a great example. Like those cap rates just keep going up because nobody. Well, I don't know about now, but for a long time nobody wanted to live there, and so you might have these great properties, but if nobody wants to live there, no jobs for people to have, then it's not desirable.
Yeah, that's why it's a tricky concept, especially for newer investors, because I think that a cap rate being high when you're out there shopping for your first property looks good. So you start looking at some of these really rough neighborhoods and you're seeing, 10 cap, 11 cap. This is great. It's like, no, that basically means that no one wants it.
right?
Yeah.
Which is usually a red flag.
What's really interesting is there's a lot of investors who will say, I only look at properties at a 7 cap or a 6 cap, or that broker who only lists at 4.5 cap. And at the end of the day, the cap rate, it is no metric to use in deciding the quality of a deal, right? You can find a really great deal that can return astounding returns at like a 4 cap. It just depends on where the opportunity is in that. And so don't get tied up and say, I only buy 10 caps or I only buy at this cap. Like that's just, you're looking at
it's a metric that moves all the time depending on where you're buying. So, I mean, there's no way that you can use that as a definitive answer as to whether you're going to look at a piece of property or not.
You could, if you're buying turnkey properties that are already stabilized and you're not doing anything, you're buying something to hold for cash flow.
Right.
Yeah.
I think for that person, cap rate could be a good thing to look at because it's essentially what their rate of return
What
is
they're
going to
gonna
be,
get.
obviously adjusted for their
Yeah.
debt situation.
They're-
But if you're doing value add, cap rate is irrelevant at the buy,
Exactly.
right? It's all about where you're going to get it to and what you could sell it at later. Like we'll buy stuff that on paper has a cap rate of, 4 or 5%, even though the market cap rate for these types of assets should be 7. On paper, when we buy it, it says it's 4 or 5% because it's half vacant and misrun. But 6 months later, it's a 12 cap. So it's like, what the hell does it matter?
Yeah, that clarification with the turnkey is really an important one. Like specifically with turnkey, because what you're buying there is pretty much an ATM. Like all you're buying is the cash flow, and so you're expecting it to be really steady. The cap rate can be a really good metric, but when we're talking about value add, the cap rate is it doesn't correlate right off the bat because we're planning on going in there and doing such a drastic change to the numbers ultimately that it becomes quickly discarded as being relevant, which creates some issues then because the seller is going to want to sell based off of the after value add assumptions. Like if it's, and this happens all the time, right? I'm a seller. I want to sell this assuming like, hey, there's a lot of meat on this bone, and so I think I should get a little bit of that cut, right? So
yeah, if you put the money in, buddy.
If I'm going to buy the lollipop, you're not going to get a lick off of it. So.
Thank you.
You've had your licks.
That's right.
You had your chance. No, I've seen that. I've seen deals marketed that way, and I think there's even a firm up here that only markets that way. They price the damn thing based on where it could be in a year after you put your blood, sweat, and tears into it. It's like
that's like selling a car with no tires.
Exactly.
It's going to be worth $1,000 when you put tires on it.
Yeah, then put them on.
And it's infuriating. I think what's most frustrating about that is that there are still buyers for that. People are still paying for that don't know any better, that don't understand. And that just frustrates me to no end. It's not that they're making a bad decision, but I'm guessing they're doing it out of pure ignorance and not realizing there is no gains to be realized if you're going to pay for that at the front.
Don't you think a broker would set them straight on that though?
No, the broker is the one that's listing it.
Oh, the brokers.
They get a commission based off of the price they sell it at, so they're incentivized to get top dollar either way.
Yeah. And if there's people willing to pay it, then what do they care? Like they have a fiduciary responsibility to their seller to get them the highest dollar,
and that's all, right? Yeah.
I think that's why this is.
I was gonna say I have had to call a broker up and say, this property is overpriced. There's just no way.
I'm sure they know.
They're
just hoping you don't. And I think that's why this is such an important thing to talk about because, the multifamily is such like a hot topic right now, and people are out there, kind of, trying to do it themselves, which is great. I mean, if you really want to get into it and you want to put the time into educating yourself and make sure you do it right and actually put the work in to do it well, then more power to you. But, back to the point that we've made multiple times before about finding an operator that fits for you, because maybe you don't have all the time to do it. Like, this is why it's important. So you don't make the mistake of just buying something based off of the offering memorandum that a broker put out. Like, it looks great, even if it's a big reputable firm like CBRE, Marcus Millichap, any of these big guys, like they're still going to be trying to get top dollar out of it, regardless of whether or not you're getting screwed over as the first time buyer. So it's a great business, but you can, if you buy it wrong, like Rodney's point earlier, how you buy something, the price you pay, you can either make great money or you could get yourself
shoot yourself in the foot.
Not too good. Yeah.
Well, one component that we didn't talk about in this whole thing was reducing or modifying the expenses, because that's a controllable aspect of the deal as well.
Yeah. And I would say the most important for me personally, I think we've talked about this before, is $1 saved is more than $1 earned. So being able to go in there and decrease expenses. The problem with that though, is it's one thing to say, hey, we're going to go down and reduce these expenses by 15%. It's another thing to actually go do it.
Go ahead. When it comes to the cost of adding value as well, I think reducing expenses is usually a hell of a lot cheaper, if not free, compared to if you're going to add revenue. Typically, you're going to have to spend money. You're going to have to improve something. You're going to have to do something. But if you just lower your utility bill, usually that's, it could be as simple as starting a RUBS program and billing back for.
Is that a massage parlor in the back
Yeah,
parking lot?
Yeah.
A rubs
It's a
program?
great way to add revenue. I mean, who doesn't want to
Wax
massage?
on, wax
That
off.
actually would probably generate quite a bit of income.
I don't know if it's the right kind of client.
Yeah,
Anyways,
you're gonna have to get your licenses.
It's a utility bill back system, though.
yeah. So I mean,
Which there's
usually
a-
with stuff like that, like maybe you just get better insurance, right? And you drop that
Yeah.
expense. Like that doesn't really take much other than some time and some phone calls. So
Those are a few areas that I see right off the bat. Is insurance is, they're paying too much for insurance. And a lot of times you can go into a place like I'm looking at a deal right now where they're paying an easy $20,000 a year more than they should be paying. And another one is payroll. If you guys manage a lot of your own stuff, so for me, I'm buying employees, and if the employees are paid too much, we may have to modify that. I talked to a guy yesterday, and it was a family-run deal. A relative was working there, and they were paying him way more than market value. And so day one, they were able to slash 30 grand off the payroll.
Mhm.
And that adds a huge number to your NOI.
And that's surprisingly common, right?
Yeah. And, things like trash and contract services, like for the pool and lawn care, are you outsourcing the lawn care, or are you having your maintenance guys mow? That can be a difference there in sometimes $15,000-$20,000 a year in landscaping costs. So there's a lot there that you need to look at to determine whether you can adjust. And like you said, Dan, I mean, it's almost free money, because all you're doing is recouping money that's already coming in through your front door and keeping it in your house instead of sending it out the back door where it doesn't need to go.
yeah, and just to tie it back to the whole, value creation thing, like you just mentioned, renegotiating some vendor contracts, saving maybe 15 grand a year. Again, that sounds like, okay, that sounds kind of cool. But if it's a 7 cap building, $15,000 a year of saved expenses is the same thing as adding income. So your NOI goes up by $15,000, and that comes out to be about $215,000 of value, right? So renegotiating some contracts for 6 figures, like, heck yeah, that's a good use of your time.
Yeah,
Mhm.
that's a sweet deal.
Yeah.
And a good operator, and I think, Anthony, you mentioned it earlier, is you have a good operator is going to be creative in producing small bits of income here and there, whether it's reserved parking, because how many times would you like to, roll in and be able to park next to the sidewalk that walks up your front door, and it's your spot. People will pay for that. Valet trash. I don't know if you guys have seen that, but it's a thing where people don't want to walk down to the trash bin, so they can put their trash right outside their door, and it'll just be picked up and taken to the trash can. People will pay for that. People will pay for internet access. We talked about this before, where you bring in a central internet and distribute it to all of your tenants. And there's a cost factor there. So it's not free to invoke, but you can produce income, to the tune of $40, $50 to $60 per unit. And it goes back to that, that $100. I mean, you're getting close to that $100 where you were adding, what was it? $1 million to the value of your property.
Yeah, in a 100-unit building. Yeah. And that was conservative too, because I was taking 60% of that income. So could be 100 grand, or it could be $1 million, it could be 1.5, somewhere in there. So, but yeah, I mean, the point is, it's like if you look at the ROI, look at how much money you spend and how much you get back at value created. Like, good luck trying to find that on anything that's not gambling. Whether it's the stock market, Bitcoin, Forex, whatever the heck you're looking at, you're not going to find that ROI anywhere that isn't just ridiculously low probability of success. Like,
Mhm.
I mean, when you look at the risk to reward here, it's just insane. I wish I had some numbers to back it up, because we've talked about an example before, but that's just looking at unlevered cash flow from commercial properties. In that Thomson Reuters study we've talked about in the past, like if you look at the risk to reward ratio for the value add business model, it's got to be insane, just off the charts.
Yeah, and I think that's a good place for us to kind of wrap up, is bringing it full circle back to one of the things we discussed at the very beginning, which is you get these killer returns with low risk, and it's all flowing out of this control that we inherently have over the assets and its underlying valuations. And it's that control. Like, you might be able to get better returns by going to gamble, but you have no control in that. Whereas in this environment, we get these great returns and a ton of control. And so ultimately the destiny, we hold our own destiny in our own hands to go in there and improve these properties. And it can't be stated enough. That's why it's super important to make sure that you're working with awesome operators. Like, they make or break the deal. So
They do indeed.
Absolutely. Well, we have one more part to this series. It's going to be next week. And if you're listening, we'd love for you to hit that subscribe button and the bell, so you'll be notified every time we drop a video. Right in there, right down there,
and wherever it is, right here.
Right, exactly. And if you have any questions, you can contact any three of us, and we'd be happy to answer any questions you might have.
Yeah, looking forward to the third part of the series next week, guys. I think we're going to be going just even deeper each week, just a little bit deeper.
Yes. Until next week. Thank you, guys.
Adios.
Have a good one.